Well, good afternoon then everyone, as we are at the end of another week of trading on Friday the 12th of July. Couple of things out over the course of this week. Yesterday, fairly action-packed day. We'll get around to that now in a minute, but Jerome Powell testifying Tuesday and Wednesday. Didn't really say anything of note on Wednesday, so we're not going to really spend any time talking about that. But on Tuesday, it kind of just reiterating the stance that they need to see a little bit more progress in terms of inflation in order to then go and cut interest rates. Right, it kind of did say that the labour market was still strong, although weakening, and a couple of other sectors of the economy was still kind of weakening, but it was still a broadly positive economy, still trucking along well at this moment in time. And then inflation, obviously the main focus of attention. That's no change to how they've been for the last few years. So that's no surprises really with that one, but kind of did come across, so the markets took it as a bit more kind of dovish, kind of acknowledging rate cuts, saying that we are getting closer to the time in which it is going to be appropriate to cut interest rates. More progress on inflation is then needed. That progress on inflation then came yesterday. We got all four inflation metrics, the 2 year-over-year prints, 2 month-over-month prints, all missing consensus. You can see 0.1 versus 0.2, 3.3 versus 3.4, minus 0.1 versus plus 0.1, then 3% versus 3.1%. Right, so the kind of negativity across the board for the US dollar. We'll get on to that now in a minute. Stocks had a slightly kind of different reaction to it, but we'll talk about that once we get around to some actual charts. We then had PPI out today. With PPI kind of gets in the way slightly, year over year, core PPI up at 3% with a consensus of 2.5, so a massive beat there. When it comes to the PPI, it kind of gets in the way of the data from earlier on the week, but you can't look past it. Like last Monday, you had manufacturing PMI mixing up my words. Manufacturing PMI last Monday out of the US, negative. Services PMI last Wednesday, negative. NFP last Friday, negative. Inflation this week, negative. Jerome Powell opening up the door, suggesting that they are approaching the time in which rate cuts will be appropriate. All of that is just dovish, and you can see that relayed on the charts. You come over and have a look at the US dollar. I'm just get rid of some of this. You can see the US dollar across the board. Kiwi, you had the Reserve Bank in New Zealand out this week, which I'll touch on now in a minute. But you can see, obviously, you got your Aussie, you got your Euro dollar. I'm mixing up. Get rid of that. I guess I'll just get rid of all that again and just show you. I mean, you can see your Aussie pushing higher, Euro pushing higher, Sterling pushing higher, Dollar Swiss, Dollar CAD, Dollar Yen all pushing to the downside. Dollar Yen, bit of a more aggressive one. I'll touch on that in a second. Obviously that drags the dollar index with it. So broad-based weakness across the board in the US dollar, and you'd have to imagine with the way the data has gone over the last couple of weeks, with the way Jerome Powell's talking, you have to imagine that is probably set to continue, and that is kind of come and affected interest rate pricing for the 18th of September. Not going to get anything on 31st of this month, right? But 18th of September, the market is now pricing for an interest rate cut from the Fed, right? With a 93.5% chance, only a 1.9% chance of no cut coming through to September. So market is fully on board with an interest rate cut in September. Don't think the central bank are too up for really disagreeing with the markets. They seem intent on cutting interest rates. I mean, theoretically, interest rates up by 5.5%, from going from 0.25 to 5.5%, is supposed to cause an economic downturn. I mean, they haven't just yet. So, the second you make a bit of progress on inflation, go slash interest rates down. I don't know. It's not exactly going too badly now, but they want to cut interest rates and get ahead of the game. It does take kind of 18 months for these interest rates to take a lag. I suppose they don't really want to kind of leave interest rates high for too long and then end up crippling the economy. So, like personally, from interest rate cuts, you can have two kind of opinions on it. I mean, from an interest rate cut point of view, like if it takes 18 months to 2 years to actually affect the economy, well then they should have already cut interest rates, right? So if they haven't already cut interest rates, you kind of would then think, do you really want to go on a cutting cycle the second you get inflation out? And let's be honest, inflation's not even really down. I mean, the core CPI 3.3, that's still too high. That is historically talking about interest rate hike territory. The total rate of inflation 3%, right? You have a look, if this wants to load for me. Right, not once has inflation been below 3% since the kind of late 2020 or early 2021. Right, March 2021 was the last time inflation was below 3%. That is over 3 years now at this point. Inflation has not once been below 3%. Not make that much sense for cutting interest rates, unless they can see something we don't. But inflation just has flatlined over the last year. You still expect that to come down with interest rates of 5.5%. So, not the type of progress they kind of wanted to make on it. It was never going to go down in one straight line, but kind of been chopping sideways a bit for a year. Core CPI, it's obviously been trending lower in line with expectations, but even that's still at 3.3%. I don't know, really, to be honest with you. I mean, theoretically speaking, if it's going to be 18 months, 2 years worth of a lag, probably should have cut already. But where it is, they're not, like, interest rates aren't exactly crippling the economy. Okay, you've had some weak data over the last 2 weeks, but yeah, you expect it to be a lot weaker with interest rates where they're at, and they're not. So yeah, I don't know. Maybe you cut interest rates and cause yourself a few problems, but I guess that's not my problem. We just got to try and make some cash off it, and for now, selling dollars is the way to go, you would think. Kiwi, bit all over the place this week. 2 week currencies going at it on that chart. It's definitely one to stay away from at the minute. New Zealand Central Bank, we were kind of expecting the New Zealand Central Bank to, or certainly I was kind of expecting them to sound a little bit more hawkish, but they noted problems across the economy in multiple different sectors. They said that inflation is coming down, and over the course of the rest of this year, in the coming months, that it will be appropriate to loosen monetary policy slightly. So, gone the other way, dovish on Wednesday morning, that was out, and, for now, markets jumped from, the kind of pricing in interest rate cuts kind of through to year end for the RBNZ. When we actually get them is another question, but I'd say previously they were looking at mid 2024 or 2024 now. It's mid 2025 they were looking at. Don't think that's going to be the case. I reckon you'll get one from the RBNZ at some point later on this year. Dollar yen's the other one. Dollar yen, you can see a pretty big move. That is not a CPI move, right? If you remember what these moves back here were, that and then that, right? You couple that with then where we're at this point in time. That is you go do some measurements, right, from the high of that candle to the low of that candle, down 327 pips, down to the low of this candle, 420. Right, that is an intervention move. Right, even look what's going on now. I mean, is that more intervention? Are they kind of jumping in over the last kind of 5 minutes to 15 minutes since I started recording this video? I mean, that's not a normal 5-minute candlestick. That's not driven by any type of data. Is that people backing out of positions? 100 pips in 5 minutes. I mean, just think about it now. Potentially, it's even more intervention, but you kind of just hack around after. But you got to, like, with this happening, if the US dollar starts to deteriorate, if you kind of broad-based US dollar weakness, there has to be so many people long term the whole way up through this, right? You're gonna need a kind of mean reversion trade. You're gonna need a big pullback on this to flush out some of those longs. If people start backing out of all those long positions, that is going to cause big downside on this particular chart. So definitely one to keep an eye on. Previously when they've intervened, the markets have attempted to go back against that and test the resolve again. But if you get this broad-based US dollar weakness off the back of what's gone on over the last couple of weeks, that chart is probably the one to play. In case of that, stocks bit all over the place, right? Kind of a bit of a pop higher on all the stocks, and then a bit of a sell-off after, especially the Nasdaq. Now, I always say with stock indexes, if people look at economic data and just go straight to the S&P 500, it's always an easier trade than the currencies, right? Always easier trade than the currencies. I probably sound like a broken record. Certainly to students, I sound like a broken record. Keep trying to drill it into them. The currencies are much easier, right? Because when you look at stocks, it's like over the last while, stocks, bad news has been good news, and good news has been bad news, right? Because if you get bad news, it brings forward the prospect of interest rate cuts, which is positive for stocks, right? But if economic data goes super negative and you're looking towards a recession, that's just downright negative for business conditions, right? So there's a kind of a flipping point. You never know when that is. Maybe that was yesterday, but could also be some profit taking in stocks after that, because kind of markets you kind of feel when we actually do get the interest rate cuts, they'll be cutting interest rates for a reason. That reason is not normally positive for businesses. So maybe that's something to have a look at. But the kind of Russell, kind of low cap, small cap, medium cap stocks, the fact that that's pushing higher kind of suggests that the broader economy probably likes it. We're going to cut interest rates, going to help the smaller companies in the broader economy, because ultimately the S&P and the Nasdaq is held up by kind of the big companies that will perform well more often than small cap and mid cap companies. So reason why that is kind of blasting through the roof would probably be down to that. Sorry, let's get rid of this. It's not what I'm supposed to be. Where am I off to? Sorry, here. Got yields continuing their move lower, down substantially from the high printed at the first of this month. Yields down super aggressively this month. Bonds bid super aggressively over the course of this month. And yields down has helped help gold push higher, but gold's kind of a bit choppy after yesterday's day. There's something like too much attention to gold. Kind of oil trending higher a bit over the course of this week. You did get another miss on oil inventories on Wednesday. Goes in line with a massive miss last week. Another miss this week. Kind of like a bit of upside for oil, but oil is certainly not the main focus of attention this week. US related assets. US dollar had a super negative week. That is probably set to continue. It has been the trend for a while across a majority of these. Cable at its highest point for over a year. And definitely something you probably got to continue to buy. With Bank of England's pill, chief economist, I believe, was suggesting there's no timing on rate cuts. No timing on rate cuts through to the year end. No timing on rate cuts, and it kind of prompt markets to kind of wind back bets for an interest rate cut from the Bank of England as well. So less than a 50% chance now at their August meeting of a cut from the Bank of England. It's now obviously less than 50% chance. So not the likely outcome when it comes to August. If you're looking at cuts in some of the other central banks, sterling is kind of bullish. And then off the back of that, your GDP figures as well out of the UK this week, which was super positive. Plus market has taken pretty kindly to Labour getting into power last week. So bullish for now on sterling. That's probably what you'd look to hit. If you're looking weak dollars, cable, dollar yen, probably the Aussie as well. That's where I'd kind of focus my attention on, or will be focusing my attention on going forward. But that's where we're at over the course of this week. Intervention from the Bank of Japan or BNZ. Weak inflation out of the US, causing some pretty entertaining volatility over the course of this week.